So, hello and welcome to this week's instalment of Nucleus Investment Insights. And today we thought we'd have a look at, a perennial topic, and certainly one, given that there's been some recent new information that's come out from the ATO, as always, with their annual and quarterly reports on the big wide world of self-managed super funds. And so what we're going to be focusing on today is the investment side of self-managed super funds in particular, and we've entitled this one the Self-Managed Super Fund Investment Masterclass. I'm joined, as always, by our Head of Investments at Nucleus Wealth, Damien Klassen. G'day, Damien.
Hi, Tim.
And with no further ado, let's jump into it. So the agenda for today is we're going to start off just by looking at some highlights from the Australian SMSF Landscape. We'll then roll into two major mistakes that SMSF trustees, we often think anyway, make in their asset allocation. We'll then, of course, cover off on some key ways to avoid making these mistakes, and then finish off by running through some key considerations before taking the plunge into a self-managed super fund. So hang on to your seats. So we'll kick it off. So obviously the Australian SMSF Landscape is a big part of the overall super system. We're looking at about 23 odd cents in every dollar of the $2.8 trillion super system resides in a self-managed super fund. So it is certainly an area of interest for a lot of investment firms to get it right, but also for a lot of people that are running these funds to make sure that it's done properly. Just to cap off, I guess, or to start off on some numbers there. So, as an update to our last one, which was about 18 months ago, there has been an increase. So there's now nearly 590,000 SMSFs in total. Number of members in there is one bit over 1.1 million Australians use that, which is one in 20 almost, I'd say. The overall estimated value of assets in the self-managed super side of the super system is nearing $750 billion, a big figure, I think, in anyone's parlance. And interestingly, I've just got the top 5 asset types held by SMSFs by value. So cash and term deposits have taken the lead over listed shares, which is interesting since we've last run through this 18 odd months ago, up from 23 now to 37% of SMSFs. Listed shares are sitting at 26, which is actually down a touch, and we'll cover off in that in more detail certainly later on. Real property and trusts have sat largely flat, and other managed investments around about 5%, and that won't fully add up, but these are just the top 5 asset types. What I'll do now is just run through, I guess, some of the key areas, I guess, or key components of what to think about with SMSF. So starting at the total number there. So interestingly, and this is obviously dragged from the ATO SMSF statistical reports, noticing a little bit of a flattening off in the total number of SMSFs. As you can see, they're rising markedly from well over for mid 400,000s now to the nearing 600. Although it seems to be sort of petering out in its growth rate, and there's actually an explanation behind that. There's been quite a marked rise in wind-ups in the last 18 months since we sort of started looking at it, combined with, of course, a falling number of establishments, which is interesting, Damien.
Yeah, so I think, I guess one of our comments for listeners in terms of if you have one, or if you have one or you're thinking of having one, is just realising there is an extra layer of work that goes into these SMSFs. You get a lot more transparency. There are some benefits in terms of franking credits that flow through, but which has sort of been the key driver, I think, for most people in terms of setting them up. But on the flip side, there's also, I think it's probably safe to say, a number of people who have quite grand ideas about what they're going to do, and then realise that, just a minute, this is actually a full-time job, and I've also already got a full-time job, or I've already got grandkids and other things to do with my life. And so, there is that question about working out how much control you want, versus the amount of cost. And in the last year, a lot more people have been deciding, and I think the ATO as well has been chasing pretty hard in terms of the number of, or ASIC, I guess, probably more chasing small
ATO, I guess, finally, but it's right,
because it's the issue for, if you've only got $100,000 in one of these, is that your running costs are probably 2% before you've even started investing your money.
Yep. Yeah. I think a big thing too, like anything, is that there's a mindset out there, and certainly people that I've come across in my career in advice, working actually predominantly in SMSFs as well, where the people like to think they could do it themselves. At the end of the day, I think it's almost part of the cultural parlance that we pick ourselves up by our bootstraps, and so why can't we do it with our retirement savings? But a bigger part of that is then maybe in a couple of years' time, and I think that the statistics are showing this now, where people are having a bit of navel gaze, realising that this may be affecting their retirement lifestyle.
Absolutely.
and having another look at it. So yeah, quite interesting. And
part of that is that this whole diversification part about it, I guess, working out. And I think as we find that the longer people have owned SMSFs, the more you find they're starting to say, well, okay, I actually use somebody else to do this part of it for me, and then I do all the stuff I like to do. So maybe retired doctor and likes biotechnology investing is saying, well, that's really great, and it's great keeping on top of all these it's quite interesting researching and seeing and picking out things that you like. But having a whole portfolio full of biotechs all of a sudden turns your portfolio into a massively volatile instrument that can go up and down. Whereas if you sort of say, okay, well, let me actually find somebody to manage a core investments and does the cash and the bonds and the boring stuff, and then you can round the edges. They can still play around with some of those.
That's right. Yeah, and I think that's a very sensible strategy. Interestingly, the technical term is that the total number of members for a super fund needs to be less than 5, and there was some proposed legislation last year for it to be increased to less than 7, so an additional 2 more to I guess bring into account the fact that these are more commonly viewed now as more of a family style superannuation account as opposed to just a mum and dad. Although as the statistics show here, 70% of super funds have 2 members as opposed to any other, and with a single member being the next largest. So the 3 and 4 size super funds, member super funds, are still largely unused, and I guess there's probably a little bit of evidence to show that maybe if it went out to 6, that it'd be probably less again.
Yeah, and I think coming back to that probably is part of the franking credit changes that were proposed by the Labor government, and I see them back in the paper again today as talking about maybe they should be. Maybe they shouldn't give up completely on the franking credits, and so I think there's an element of going at that stage. If they do ever get in and put those in, you do and you want a mix of retirees and non-retirees to get the best tax benefits from it.
Yeah, well, that's
because
right.
You want to be able to offset some of the tax gains and losses within various parts, and so so something to keep in mind just for the future is that if there are going to be tax changes, then you probably do want more members just to spread those tax issues around.
Well, that's right. Yeah, and there was a strategy rolling around, I guess, in preparation for potential CG for franking credit changes, where by bringing in younger members, you could quarantine the potential losses from people in retirement. With Labor not getting in, those changes not getting in, I guess the ability to have 6 is probably less important now. Yeah, and interestingly, it was knocked on the head in early April. The 6-member SMSF bill, interestingly, combined with an excise change in craft beer. So yes, two of my favourite topics combined together, and then it didn't get through. But feel free to research that one in your own time. So, interestingly, the demographics of age ranges, and I've got a couple of slides on this one, but the demographics, I think it's to be expected. So you've sort of got this hump in the 45 to 75 range, sort of making up the lion's share of ownership in SMSFs. What has been interesting, though, is the new establishments. So this has just sort of come out from this most recent report, where there's been a marked rise in the 35 to 54 range, taking up now the lion's share of people getting in. So I guess it shows that there is a lot of interest in the 35, so the 30-year to retirement sort of zone onwards, in the new establishments in the last quarter. Not sure, as a owner of a trustee of an SMSF, Damien, when did you kick your one off? Would you fit in? Does this one make sense?
Yeah, I guess for me, I kicked it off at a younger age, but I've been in investments all my life, and so that's probably not the standard case. I would hazard a guess that, and it is just a guess, that there's a chunk of that is the that's borrowing to buy property within a self-managed super fund, and that's been a big push that we've seen through through various financial planners, and we ran a podcast on it about 6 months ago or so, just showing that some of the assumptions that are being suggested to people who buy this is basically, here, buy an asset, gear it up as far as you can, and the asset usually will return 10% per annum, and look, you'll be a multi-millionaire in 20 years' time. And it's saying, well, yes, that's perfectly right, as long as your assumption that 10% per annum is a sensible assumption. And So I guess that's why my concern is that there's a lot of people who have been enrolled into a self-managed super fund.
Yep.
And the ones we've seen is all about, can I afford to do these interest payments, or can I afford to pay off my investment property that I'm about to buy, and less about whether they should. And so,
particularly if they're holding a lot of property outside of super as well.
Yeah, absolutely. So, yeah, that's...
It's a great point. I've got a chart coming up actually that'll help back that point up exactly. Interestingly here, so I've just got the proportion of total assets in segments, so broken out into the various total amounts per SMSF. So as you can see there, that once again the lion's share sort of sitting in that middle band of larger than 200, and then capping out sort of, or finishing up that pig in the pipeline, so to speak, of 2 million. To be expected, I think. So what I'm actually going to do is just use a couple of those. So I'm just for the later charts, I'm going to use a 200 to 500,000 band, and give you a little bit of insight into some asset allocation at that level. And then we're also going to look at the 2 to 5 million. And the reason for that is because, in my experience, the 2 to 5 is typically where you'll find the true self-managed super fund member who may wish to just do it themselves and pick themselves up. Whereas in the 2 to 5 range, you'll often find there's a degree of outsourcing done, either it be investments.
Sorry, just to clarify, that was the 200 to 500,000 range.
200 to 500
is where you see the self-managed person who's doing it themselves.
Yep.
And the 2 million plus, 2 to 5 million, is where you've got professionals involved in it, and they've set the structure up for this person to... That's
right, yeah, just to make that clear. So we'll roll into it. So I guess the first mistake, and we mentioned that we're going to run through a couple of mistakes that we often see, is doing nothing. And the amount of self-managed super funds I've seen that started either of a client's own volition, or through a recommendation of a friend, or through an accountant perhaps, and they typically will roll the money out of a master trust somewhere, whether it be an industry fund or a retail super fund or something like that, and then it goes into a cash account in the self-managed super fund, and then the following year they sit down with the accountant and it's still sitting in cash. That's very, very common. So a big point there actually was quite interesting is that you can see that in just those two examples of the true self-managed, I guess, sort of range versus the advised range, although it is decreasing, which is good to see year on year. The other, I guess, and then rolling on from that is, if you're doing nothing, if you're not doing nothing rather, then the second mistake is you'll quite often then just follow the beaten path of doing what you know. So for Australians, parochially, we know cash, we know term deposits if we're investing outside, and we know property. And then so these are the two levers that are often pulled. Once again, you can see that there was a little bit of a rise, I guess, in that self-managed. Seems to be dropping off a little bit in 2017, and I guess on the other side of the coin, you've now got a lift in the larger band, in the 2 to 5 million range, where it is actually, they're starting to climb into real property as well. Outside, look, I've been out of the game, for a little while, I guess, in the true everyday self-managed space, but I haven't heard too many reports as to why the advice side would get into real property. Perhaps it's I was thinking perhaps commercial property might be where it goes, but residential.
Yeah, and then the question, as in that second mistake, sticking with what you know, I mean, the question always comes back to residential property for me is, if you've already got you already own your own house. A large proportion of the Australian population work in some sort of industry that is related to Australian housing. Yep. So sort of 20%, whether if you're in a bank or even something like bank or real estate or other sort of things that are just based around that whole housing market. Often people will also own an investment property of their own, and then they feel the need to also put their superannuation money into property, is saying, well, you're basically taking a one-way bet with everything and just sort of everything on black, thank you. And if anything else comes up, it's
off you go. It could also be. I think we've had a terrific run, obviously, in property prices where people may have bought an investment property, negative gearing, all the rest of it years ago, had a win, felt like they know what they're doing, and then the opportunity comes to sit. Someone throws something across their desk, and that sort of leads us a little bit into this next chart, which was just a quick snapshot of what they call limited recourse borrowing, which is effectively how you can borrow to buy property within self-managed super funds. Marked rise in sort of tenfold rise in 5 years, essentially, is growth in the amount of borrowing that's going on. Cause for concern, potentially. I know it's it was certainly a bit of a hot button topic throughout the Royal Commission, it remains to be seen what's done through legislation to try and perhaps slow that down and potentially stop a bubble being blown.
But I mean, the main thing to take away is that from that graph is that 5 times as many people who are doing it themselves end up taking a borrowing out in their super fund versus people who have been under advice. And the message there is that for the bigger amounts and people who are managing large portfolios, they're just not touching the gearing.
The gearing stuff.
It's just there's you don't have the same upside and downside.
And there's so many other options once you're in that investment landscape.
And it's so expensive within super funds as well. It's usually a lot more expensive to do the borrowing within your super fund than what it is outside of your super fund.
Yep, good call. So sticking with what I guess is essentially, and this is once again just a bit of a reflection on the lower versus the higher examples we've got, but a more weighting or higher weighting here clearly for listed shares in that larger band. Wouldn't say it's a whole lot more. It is actually quite interesting, and I'll roll into the overseas assets, but the report doesn't do a terrific job in clearly defining what's Australian and overseas assets. It's actually quite difficult to work that out because they use trusts and other areas. But this is the best I can put together from the report on overseas assets. Clearly, I don't think the percentages are quite representative of super funds, but it does once again illustrate that the advice side of the or potentially under advised side of an SMSF favours an overseas investment over a smaller fund.
Absolutely. If you go to an asset consultant and I don't know if you could find any asset consultants who would turn around and say, no, you need to have all your money in Australia, and and particularly in Australian property, that's your best environment, best retirement strategy. They will generally say you need a broad spread, and that you need these international stocks as well as Australian stocks. And so, when people are running their own money, it's very easy to go, well, I read about BHP every day, and I open up the Fin Review, and I can, read about these stocks, and so they're the ones I want to invest in, versus actually saying, no, it's a much broader world. Australia's sort of 2% of the global index, and there's so many products that you use every day that aren't listed on the Australian stock market. And if you want to get exposure to those, to most of your life, then the other 98% of things that you buy, then you need to head offshore to do it.
Great point. I'll just finish up just the little chart pack I've run through there with what I actually like. I really like this one. This is from Graham Hand just recently in Cufflinks, which is an online one. Feel free to check that one out. But I'll better hat tip him because I'm using his chart here. But interestingly, so what he's done is he's broadly broken up the asset classes, and this is once again using the same report, but highlighting the fact that there has actually been a conservative trend. So there has been a wind back in the last, let's call it 5 years, towards cash and away from direct shares. Anything you think might be a background for this one? Do you think, Damien, just off the cuff, links?
I'm just thinking through that. Look, I mean, it's interesting that's actually been a cracking. We've had a cracking 5 years on most of the stock markets.
Exactly.
It is a question of saying, sometimes there's. So I guess in a way it's a sign that people weren't fully allocated. They had way too much cash 5 years ago, and I think there's coming back to your point before about the people, when people feel good about things is when they invest more. Is a classic mistake you see a lot of retail investors make is they look at an investment and they say, okay, I'm going to dabble a little bit in shares, and they go, okay, I've got $1 million to invest, and I'll put 50,000 into shares. And then there's a cracking year and it's up 20%. And they're like, oh, how good was that? I made $10,000. I should have put more in there.
Yep.
And the next year they go, okay, well now I'm going to put $100,000 in there.
Right.
And next year they get another 20% return, and they're like, oh, well, imagine if I had invested more. And the next year they go, whack, here's 900,000 into shares, or my full $1 million into shares, and that's the year you have the downturn.
Yeah, right.
And then it's like, okay, I'm not going near shares again.
That's right. Yep.
And you spend 5 years worth of. And that's, I think you could probably track from the rise in cash there from the financial crisis in 2009. You just see people go, I've got to get more conservative. I'm never going near shares again, never going near shares again, never going near shares again. Oh wow, shares are up 100% over 5 years. Oh wow, now I've just got to start piling in and doing it too late.
Yep.
And so that's all. Is the concern is that it's following. You're getting reinforced by what's happened in prior years without that expectation of saying, well, you're not going to make 20% every year in shares.
Yep.
And you are going to have, if you've strung together a few great years, the odds are at some stage there's a bad year coming, and more importantly, when there's a bad year or a couple of bad years is definitely not the time to say, well, I'm never investing again. I'm going to sit on cash for the next the next 20 years.
No, great point, and leads us beautifully into the next side of it, which is, I guess, more of the psychological sort of piece that goes in behind the investing scene. So.
Yeah. So, this is a part for investing what you know. So there's a couple of famous books out there by Peter Lynch. One is One Up on Wall Street, and the other one's Beating the Street. And his message all comes back to, you walk into a shop and you see everyone buying some sort of product, or your wife loves this, and all the friends are buying it. Then go out and buy the stock, and you'll benefit from that. Sort of what insights can you actually get from being on the ground, or if you're working in the medical industry, you'll have bigger insights, or somebody in the engineering. What do you see in your day job that helps you? Now that's not. There's certainly a case for that, but it's important to note that it's stock picking advice. We're not talking about asset allocation advice.
Yep.
Because these are finding stocks that you really like and you're going to take a big bet on. It's not about finding an asset allocation strategy, which is all about diversification. It's actually about the opposite, about saying you need to make bets on things you don't know about.
Yep.
Because almost by definition, you don't know everything, hopefully. And if you did, then you're probably not listening to our podcast. Yeah, exactly. Asset allocation is really about saying, well, I might know a lot about Australian shares or a certain pocket of Australian shares, but I need to buy some international shares to get some diversification for things that I don't understand or things that I just don't have time to research.
So essentially, for those listening at home that haven't got their head in the investment space, the stock picking side of it is more of a micro piece inside of an asset themselves. So, for example, Aussie shares, a stock in that allocation, whereas the asset allocation in holistically is macro. It's saying, okay, what's the economy looking like? How's it going to impact this asset? Be Aussie shares, overseas shares, bonds, cash, etc.
Yeah, yep. And I guess what I'm saying is, if you're running your super fund and talking about our investor before who started dabbling in shares and then all of a sudden went all in and just at the wrong time, is about saying, okay, well, I've got $1 million to invest. I'm going to then choose and say, okay, well, I'm going to put 500,000 of that into a mixture of bonds and cash and some safe shares or whatever it is that's going to. So I know I've got this stable base and that's going to be a decent performer in the middle, and then around that, now I can go, okay, well, I'm an ex-doctor and I wanted to buy some biotech stocks, or I've heard some great things about electric cars, or I love my Tesla, or whatever it is that you want to stick around that, or I've got this great hedge fund tip that somebody gave me. Sure. And then you can go, okay, I'll put 50,000 or 100,000 in some of these other assets, with the idea that it's all about that diversification and saying, am I taking the bets? And then, so if you are picking stocks, then it's about saying, well, how much Australian equities do you want, for example, in your portfolio, and taking a big picture view of it, say, okay, well, I want $200,000 in Australian equities, for example. Okay, now how am I going to divide that, as opposed to starting from the bottom up and saying, well, I'll have one of these and one of those and one of those.
Like a kid in a lolly shop.
Exactly. And when I get to the end, I'm like, well, just a minute, I've got too many lollies here. Now I've got $500,000 worth of shares that I've just bought. Yep. Oh, well, I'll just stick with that. Yep. It's actually saying, no, you need to start from the top down. How much am I allocating to each different sector? Now go out and find the ones you want. Mm-hmm. And it's always hard. The hardest thing with any of this is an asset allocation is when it comes to saying, I've made a decision to go underweight shares, for example. So I need to go through my portfolio and sell some shares. It's always difficult because there'll be ones in there you'll just be like, oh, that one's going to come good. I know that one's going to, whatever it is. And so it's gone down, but I know that's going to come back. And so there's always it's always a hard emotional decision. And to go through and go, well, no, I've just decided I'm going to halve it. I just need to halve everything and get out of that.
Yeah,
So what often people do, especially if they're managing their own portfolios, they might even hold an exchange traded fund within their portfolio, so that they can just then make a quick decision to say, okay, well, let me just halve the exchange traded fund because I don't feel no emotion about that one. But this stock I bought because I really love it and I'm nurturing it and I feel as if I'm on with a team.
Yeah, sure. Okay. So, great point.
But a lot of that's about fighting these biases, and that's I've got just the top 10 biases up on the screen. But if you are managing your own self super fund, having a good look through some of the most common biases and trying to work out where you make them. I've got confirmation bias, loss aversion, optimism, self-serving, and planning fallacies. I think the main thing is that with a lot of these is that it's about things that everyone makes. So everyone thinks they're a good driver and everyone thinks they're above average at sex. And so, and by definition, not everyone can be above average at both.
Yeah,
so
fair enough.
You need to have an even split. It's pretty similar in investing that most people and some of the stats they've shown is that when people say that they're 99% sure about something, they tend to be right about 80% of the time.
Right. Okay.
And so
it's about recognising that.
It's about recognising that people are overly optimistic on all these things, and it's about recognising these that confirmation biases where you're trying to find things that agree with you, or you get that confirmation bias like I was talking about the guy who was just dabbling in shares and then that worked really well and I've got to invest a bit more and so it's just because you've had a few great years, don't sort of figure that right, I've got this whole thing licked. All I need to do is just throw more at it, or maybe I just need some gearing to sort the whole thing out. Then I'll retire a millionaire.
Yep. Okay. Sure.
So,
a few more
up there. Yeah. And it's worth noting as well that there's everyone's always got some very interesting stories about stocks they bought that are gone up 5-fold and 10-fold and all that, and nobody ever wants to tell you about the ones that they had that sort of closed out the bottom of the portfolio.
Yeah,
but
so the gambling sort of side of things, isn't it? You hear about the wins and you don't hear about the losses.
Exactly. Yeah. And so and that's one of these biases you need to keep coming back to, is when you're hearing the great stories about how well people have done, is you're not hearing both sides, and when you average out, what the markets are doing, and so you can sort of see where you're sitting, and it's well worth people sort of seeing where they do sit in their own portfolios versus the markets and the volatility in it, to make sure that you are actually adding value to the whole process.
Yep. Okay. Sure thing. And obviously, for more info on biases, there's plenty of info out there on the web to do with the biases, and go and have a crack at your own personal ones.
Exactly. Yes. It's probably as an investor, it's probably the most important thing you can do is try and work out what are my own biases, because it's where you're most likely to stuff up from your own biases, not from...
And do it again and again. Yep. Okay, yeah. Sure thing. So bad timing.
Bad timing, yes. So there's all these arguments out there about, do professional investors add value or not? And you can read a lot of papers out there that will talk about saying there's one from S&P, the SPIVA survey that comes out every few months, and talks about how professional investors have underperformed after fees, and they go through all these bits and they have all these arguments about why professional investors are no good. Mm-hmm. But we know professional investors are no. But the thing is, when we look at average retail investors, we see a much bigger underperformance, and for me, I keep having to come back to saying, well, the market's made up of it's the same as the good at sex and above average at sex argument is, we know there's some people outperforming, we know there's some people underperforming, and there's range between. What tends to happen is retail investors tend to underperform, institutional or professional investors outperform, and then they take fees. And so depending upon who you're with, those fees can actually send you back out the other side.
Drag you back to the index, so to speak. Yep.
Yeah. So if you're out there paying 2%, 2 and 20, they call it, in the hedge fund land, 2% of your 2% of what you've got and 20% of any performance, and there's potentially an advisor or 2 or 3 middlemen also sitting between you, then your guys might be doing fantastically well. They might be outperforming the market by 4 or 5%, and you're underperforming because
net of fees,
they're taking it all off you.
Yep, sure.
So so the average, but coming back to the average investor, they generally underperform by about 2% per annum. Most of the studies show. And most of the reason for that, there's a few different reasons, but most of the reason is bad timing, that they sell low and they buy high.
Okay.
And it's a natural sort of tendency that everyone has, and it's something that you really need to keep in mind, is that as an investor, people tend to buy and sell based on their perception of risk. So, and people have it almost completely wrong. So the market goes up 100%, and people think, fantastic, how good is this market? It's up 100%. I need to buy more of this thing.
Yeah, sure.
As opposed to saying, looking at the valuation side, because at times the value, the earnings haven't changed and just the valuations have doubled.
Yep.
And so all of a sudden you're looking and saying, well, we've gone from being, say, average price to horrendously expensive. And so then therefore, that's the time to be selling, not the time to be in there piling in more.
Yep, sure.
And vice versa on the downside. And so what people tend to do is if earnings have been, if share markets have been quite steady and rising, you see floods of money coming in, and then when you have some sudden sharp downturns, all of a sudden everyone wants to sit on their hands, and even people beforehand. So a lot of it's about writing down what you're going to do and saying, I'm expecting this to happen. So right now, a lot of people are expecting share markets to fall back, and us included.
Yep.
And it's about saying, okay, well, I'm expecting a fall in share markets, and I'm expecting these factors to happen. And so if that happens, then I should go out and buy. But what will invariably happen is when the share markets do fall, there'll be headlines everywhere saying panic stations, earnings have fallen, trade war worsens, US going into recession. There'll be all this stuff, and people just, they freeze.
Yeah,
and they basically go, oh, I knew it was coming, so I've done really well, but now I'm just going to wait until, wait until Armageddon happens, because that's, everyone's now talking about Armageddon.
Yep.
And don't jump onto that other tendency. So
and that's normally, when you're saying that, I indicate that when the sea of worried broker photos appear on the front page of the AFR. That's normally to me, that's when you can ring the bell.
Yeah. and there was I need to get more references to this, because I keep talking about it. But there is a very well performing, a fund manager who sort of outperformed the market over years and years, and in a discussion he was sort of asked about, I think he had sort of 3-4% outperformance, and he was asked about how his his investors must be really happy, and he said, he thinks his investors on a money weighted average had actually underperformed the market.
Yep.
Because they kept on trying to pick out whether they would try and not only trend follow the market, but also trend follow him.
Yeah.
So
right.
if the market had strung together a few good quarters, and he would have strung together a few good quarters.
Big rush in.
There was this huge rush in, and then the market had a few bad quarters, or he had a few bad quarters.
Yep.
And there was this huge rush out.
Yeah.
And
right.
So he'd done the numbers to actually work out that on average, people on a money weighted basis, that actually underperformed by trying to not only time the market, but also time their fund manager's outperformance.
Wow. Yep. So overriding the whole thing with their own biases, essentially.
Exactly.
Okay. Very good. So another one is reducing the opportunity set.
Yeah. So I've just got the this is just on different markets, how big that underperformance has been for retail investors. It's an estimate by I think it's Morningstar.
Okay.
I haven't put it up on there, but yeah. So basically, in aggregate, they've got it as 2.5% down, but varies between some assets. Where in US equities it was only just under 2%, whereas in some other ones it's sort of as much as 3%.
Yeah. Right. Okay. Sure thing. So we'll jump across into the order of the day. So diversification, and we'll cover off on what we think the typical Australian portfolio looks like for mum and dad investor.
Well, yeah, I guess I wanted to highlight this one because we've seen a number of SMSFs come through that have these characteristics where they go, they've got their own residential home. They've got five assets, own their own residential home. they have an investment property somewhere. They've got a bunch of bank shares. They've got some hybrids, and they've got a corporate bond ETF to sort of sit there and say, okay, I've got this nice diversified portfolio.
It does look very diversified on the surface, doesn't it?
Yeah, well, everything will be fine. And so, but when you dig in a little bit, you've actually just got 5 different exposures to the Australian housing market. So Aussie banks have basically got one of the highest exposures in the world, and by a long shot. As if you look at their residential property lending as a proportion of the total loans that they make.
Sure. Yep.
So if you're buying an Australian bank, you're buying a leveraged play on the Australian housing market. So there's
correlation.
A very strong correlation between that. So your residential home, your investment property, and your bank you're playing the same game.
Yep. Okay.
And the next one is they go, well, I've got some hybrids. And you're like, well, hybrids, how I describe them, is not an institutional asset. So when banks make hybrids, they're there to sell to retail investors.
So, and for those at home, hybrids are they're generally ASX listed. They have the surface qualities of a fixed income style product because they generally pay quite an elevated rate of interest. So go back 3 or 4 years ago, all the big banks were rolling things out at 6 and 7 and 8%.
And sometimes they've got franking.
Yeah, that's right. A bit of franking thrown in
as well.
Yeah, they're very enticing if you didn't look below the surface. But go on.
And so you always have to be worried when you're saying here is an asset that professional investors look at and go, no thanks, I won't have any of that. But retail investors will take it.
Yeah, sure.
And you say, well, there has to be something. What do retail investors know that all the professional investors don't know?
Yeah.
And what the retail investors know is, well, we like the franking credits, and we like a nice high yield. Nice high locking yield.
Yep.
Whereas the institutional guys are looking at this and saying, for the risk you're taking, you're basically getting all the upside of debt, which is none, and all the downside of equity.
Yeah, sure.
Or most of the downside of equity. Sorry, yep. You're one step above the equity rung, and so.
So by that we mean that if we have a big share market fallout or the banks themselves come into serious trouble, the ability for the need for them to repay hybrid holders is quite substantially lower than a lot of their other debt that they issue to institutions, for example.
But part of it as well is like when you have debt, you usually want having debt in your portfolio because you want some safety and you want that regular income stream.
Sure.
And so if you've got something where the income stream can be stopped if things start going badly, things go badly, the share market crashes, your hybrids, the share values plummet. Next thing, they're not paying interest payments on it. You might end up getting all the money back in the end. And for a lot of these, you probably will. But when you need it most, they've just you had it there because you wanted it for security, and then you didn't get the security when things
absolutely
went terribly. Whereas in other sort of government bonds and other bonds like that is where you do get those benefits.
It's where there is a flight to safety.
Absolutely.
To a downgrade. Sure.
And then the other thing is, most of the hybrids are banks by issue size. Yep. So so if you just bought a portfolio of hybrids, you've got more exposure to banks, which is again more exposure to the Australian housing market.
Okay, sure. So if we move away from hybrids being purely in the potentially retail domain, then we've got the next level up's typically sort of your corporate level debt
bond ETF. So I mean, I'm picking a little bit on this one, but the Russell Investments Australia Select Corporate Bond ETF, last I looked, was the largest corporate bond ETF listed on the Australian market.
Okay.
Now, I'm not saying corporate bonds do provide some diversification, depending upon what type of business cycle it is, and a whole bunch of other caveats to that. Yep. But they are certainly more diversified than buying shares. But I just wanted to highlight here is one of the largest ones listed on the Australian market, and the Australian corporate bond market is not deep. So generally, Australian companies will go overseas to raise money,
sure,
and sort of hedge it back or do whatever it takes to sort of get it back to the right currency. So if you look at the Australian corporate bond ETF, I've got the top 10 holdings, I think there, and they're basically banks and Telstra.
Yeah.
So 8 out of the 10 are banks, and you get some Telstra holdings as well, just to round you out.
Yep, sure.
So yes, it's a diversified corporate bond ETF. It's but it's one more exposure to the banks, which we spoke were on more exposure to Aussie housing. So I guess for me, you got to keep coming back and digging through all these and saying, what you think might be a nicely diversified portfolio, if there is a common thread running through it all, when something goes wrong in that, every single one of those dominoes starts to fall over.
Okay, sure. We've got you've touched on here, you've got a chart on US stock bond correlations. Could we run through this one? So
I've got just a few correlation ones. So the idea behind this diversification is you want stuff that's going to move in different directions. So when markets are going, when markets are going down, you want some assets that'll go up. When equity markets are going down, you want some assets going up. And then when equity markets are going well, those same assets might not do very well at all.
Yeah, sure.
And so they're the types of assets you get that will give you some diversification. They'll always hurt when you've got them they'll always feel like you're doing the wrong thing, because you'll be sitting there with these bonds in your portfolio and equity markets are going up 20-30%. You're like, oh, why didn't I just have more equities? And it's like, well, because when that's your war chest. The fan. Yep. Yeah, that's right. Those, if you've got the high quality bonds or government bonds, actually preferably both, then when problems happen, they're the ones that hold up and give you, and actually usually pop up in price to give you a chance then to go and take that, sell them, go buy equities with it.
Okay.
Now they're not always correlated, and the correlations do change over time. But and I've just sort of got a 100-year-odd chart up there just to sort of show that you can go through different periods where you get some correlations heading in the same direction and other directions. But the key thing is you need to work out where you are in the cycle and whether they are going to be useful at that point. And making sure you are properly diversified.
Okay, sure.
And so I've got another chart up there just showing a bunch of different assets, and sort of some greens and reds as to showing which ones are diversified with others. So if you're buying corporate bonds, they're more correlated with the stock market than government bonds, because when stock markets do have big sell-offs, there's often problems. It is often related to problems in with companies going broke.
Yep.
And so you can see some correlation between those. And so you want to try and find things that are as uncorrelated as possible.
Of course. Yeah. Yep.
So with the proviso that both assets are actually going up. So over the medium term.
There's still upside in everything that you're investing in.
You can find some great correlations in, here's an asset that always goes up and here's an asset that always goes down. is a great correlation, but it's not a very good investment strategy.
Yeah, gotcha.
So both investments do actually need to add up but you just want them to be out of cycle. And that's where some international helps as well. Because they say there's a lot of things about, it's just, you just need to spend some time and you can take on more risk, and if things go down, you just hold on and eventually they'll recover, and that may be true.
Yep.
But we're in stock markets at the moment that are all just hitting the same highs they hit 10 years ago.
It's amazing.
And so it can take a long time.
Yep. Okay.
And so you want to try and be in assets where you don't have to be, not living the lifestyle you want to live for a 10-year period while you wait for your assets to recover from the last fall. If you've
Absolutely, and particularly important, in that later stage of superannuation, being a retirement vehicle, to ensure that you've got something you can eat while you're waiting for the relevant asset classes to recover and go from there. That leads us into our final notes. So, I guess. I just sort of stuck up there that SMSFs can be a great solution if you do want that full control. They're basically the go-to if you want to have all the levers in front of you and you want to, you basically want to be responsible for everything that you do. A couple other pros for SMSFs is the ability, as we mentioned before, to combine assets with a spouse and family, although only less than 5, not less than 7 until probably another government or two away. Much broader investment palette available. We spoke before about real property, and there is some limited borrowing available at a cost with that extra level of control. You do potentially get some more flexibility in retirement, is always a common selling point for SMSFs, because you've got the ability to swap in and out, essentially, if it works for you, between the accumulation and the pension side of super. So there's a lot of accounting that can go on behind the scenes that can yield you a good outcome, as opposed to when you're in a master trust, you've actually got to fire up a pension and move money into it and draw pensions from it. When you're in an SMSF, it can be a little bit more fluid, as long as at the end of the day you're staying within the legislation. And often trotted out one as well, of course, is it can be cheaper. So master trusts are generally priced at a certain rate, normally under an assets for the admin and the investment sort of side of things. However, with higher balances, particularly on the administration side, you've got fixed costs, accounting costs, and compliance costs that with a larger balance can make the administration side in particular cheaper. But of course, also
can also be a lot more expensive.
That's right. Well, that's right.
Yeah.
And this is the whole point. You need to ensure that you've got the time to spend on the management of the fund for your own sake. You're in charge of the money, and it's on you if you make a mistake. The complex tax affairs, so people that have got trusts and all sorts of pieces, particularly rolling into retirement, SMSFs can be a quite a good complement to those broader pieces. But once again, with the proviso that you've got a good quality accountant or advisor or someone helping you to get the most out of those structures, so they're not all working in isolation, because then I just never seen that work well. And as always, with complete control comes complete responsibility. And I don't know how much more we can round that one home, but and just finally, I guess, and perhaps we've seen ourselves roll into it.
Yeah, actually, just one other thing I just want to say on the trust is that there are a lot more options now as well than what there were a few years ago in terms of in terms of giving people flexibility. So with some separately managed accounts and things like that, you can often get certainly not the full flexibility you get with an SMSF, but you can get part of the way there. And so if you are thinking about do I need my SMSF, and should I just switch it into just a normal super fund or whatever? When you lose that, if that's something you've been considering, then do it now. Don't wait until the end of June. Don't wait until the end of June, because you'll just have another year's worth of tax to pay and another year's worth of things to fill out. And don't even wait till the end of May next year, because these things take a while to wind up and get everything sorted.
100%.
So do it now if you're thinking about shutting down. So you've only got to pay this year's fees, not next year's as well.
Well, that's right, absolutely. And then just sort of finally, I guess, and where we've seen ourselves fit nicely into the SMSF sort of piece, for those that are comfortable, or one of the reasons that they have it is because they like to, take advantage of areas that they might not be able to through an industry super fund.
Yeah, sorry, I should just say as well, if you're going to start one now as well.
So that's true.
You get a full year's worth of value. You don't start it in start it the 25th of June next year, right. and you get a full year's worth of accounting audit issues.
Your accountant would love you for that.
With 5 days of actual.
That's true. And that's right. And just getting back to that, the whole point of with the SMSF and the enhanced control and choice over your investment palette is for us. There's always a core need to have large cap stocks, cash, bonds, etc. in there, and what potentially, and we've seen this with clients of our own, that they like to focus on one particular area that's relevant to them. And you mentioned before, say, working in the medical industry and having a penchant for biotech stocks. Focus on that. Use an investment manager, be it us or whoever, to look after the boring part of the portfolio, so that you can actually spend the time that it deserves on the spicier areas of investment that do need high levels of management, and mistakes can be certainly a lot more costly. On that note,
we've also got a question.
Sorry, we are shooting this live. So we've got a question here regarding bail-in laws. The overarching question is that, do you feel that Australian self-managed super fund money in bank accounts is still safe, given the potential for bail-in laws? Have you got 2 cents to rub together on that one there, Damo?
Yeah, absolutely. So this is you often see there's a few people who are quite concerned about the whole bail-in laws, and look, it is genuinely, according to the letter of the law, a threat for people that things could happen and your money could be bailed into the banks. My personal view is that's with what do we see there? 1 in 20 accounts in 1 in 20 Australians in SMSF.
Yep.
If a political party would like to give up 1 in 20 of its votes, then 1 in 20 of votes from all Australians. So 5% of, which is probably more like 10 or 15% of company's own a political party's own votes for a generation or two, then they might consider doing the bail-ins. We fully expect that that for major banks, and they've already been anointed too big to fail, is that you won't see the bail-in laws affecting you until
they can't print money anymore.
Until they can't print money. There's something broken at the printer at Martin Price. And keep in mind, you've also had to be through a whole range of other people within banks as well. Like there's wholesale depositors, there's equity holders, there's like a raft of people who have been wiped out before you finally get down to the depositors. Depositors are basically
the voting population in
not
totality.
The voting class, but also pretty much the last set of people, maybe some employee entitlements and things like that. But you're one of the last sets of people who is going to lose their money in a banking run. And so for me, it's not something that I guess what I'm saying is if we get to that stage, there's going to be much larger problems with society than
Yeah, SMSFs.
Exactly.
And taking haircuts. Okay, no, well, thanks for that. And that leads us beautifully into our topic for next week, being rates to zero and beyond. So we will be exploring, and maybe we'll pop that one up if we can get our chief strategist, David Llewellyn-Smith, along to have a chat about that and maybe get his ideas on the prospects of things like bank bail-ins as well. So same bat time, same bat channel, Thursday the 25th of July, 12:30, and head over to our Nucleus Wealth live webinar page available through www.nucleuswealth.com to view that live and also have your questions answered. And on that note, well, that's it for now, and thanks for watching. If you like what you heard today and you'd like to hear more, head over to nucleuswealth.com/subscribe. Give us your email address, and in return, we'll send you a weekly email with new webinar topics, links for our podcasts, and other news from Nucleus Wealth. I certainly hope you've got something out of today, as I have, and we'll look forward to catching you at the next one. Cheers.